If I start investing from zero today, here is exactly what I would do step by step. No fluff, no fancy jargon, just the real plan. And I want to be straight with you before we even get going. Most of what you've been told about investing is either wrong or it's designed to keep you confused, so you keep paying fees to people who don't have your best interest at heart. I've made money in markets. I've lost money in markets. I've been flat broke and had to figure this out from nothing more than once in my life. So this isn't a theory I read somewhere. This is what actually works when you don't have some trust fund backing you up and nobody's coming to bail you out. If you're sitting there thinking, I don't have enough money to start, or investing is for people who already have money, I need you to throw that thought in the trash right now, because it is the single most expensive belief you will ever carry, and it's kept more people poor than any bad stock pick ever has. Stick with me for the next 30 minutes because I'm about to hand you the exact playbook I'd use if I woke up tomorrow with nothing in the bank. Before I go any further, I need to say something, and I mean this. What I'm about to walk you through, most people pay real money to learn. Financial advisors charge you a percentage of your portfolio every single year to tell you a watered-down version of this. Courses charge hundreds, sometimes thousands of dollars for less than what you're getting right now for free. So do me one favor, hit subscribe before you keep watching. Not because I need the number to go up on some dashboard, and because this channel is where I'm going to keep giving you this stuff for free week after week. And I don't want you losing it in the algorithm 3 months from now when you actually need it. That's it. That's the whole task. Now let's get into it. Here's the first thing you need to understand, and it's going to sound harsh, but I mean it with love. Money is not your problem. Your relationship with money is your problem. I know plenty of people who make $200,000, $300,000 a year, and they are one missed paycheck away from disaster, because every dollar that comes in already has a job waiting for it before it even lands in the account. Bigger house, bigger car payment, bigger everything. And I know people who make $40,000 a year who are quietly building real wealth in the background because they understand something the high earners don't. Wealth isn't about how much you make. It's about the gap between what you make and what you keep and what you do with what you keep. So when you tell me you don't have enough to start investing, what you're really telling me is you haven't made investing a priority yet. And that's a fixable problem, not a permanent one. Now look, I get it. Rent is expensive. Groceries are expensive. Gas is expensive. Everything feels tighter right now than it did a few years ago. And I'm not going to sit here and tell you to skip your morning coffee, because that's not actually the reason you're not building wealth. That's a lazy answer. And honestly, it's a little insulting to people who are genuinely struggling. And the real reason is bigger than a $5 coffee. Most of us were never taught how money actually works. We were taught how to get a job, show up on time, and collect a paycheck. Nobody sat us down in school and explained what a brokerage account is, what compounding actually does to a dollar over 20 years, or why owning a small piece of a business is fundamentally different from trading your hours for a wage. So today, right now, that changes for you, because once you understand this game, you genuinely cannot unsee it. And once you can't unsee it, you start making different decisions with the exact same amount of money you already have coming in every month. Let's start with step one. And this is the step almost everybody skips. And honestly, it's the reason so many people get burned in their first year of investing and swear off the whole thing forever, telling everyone the market is rigged. Before you put a single dollar into the market, you need what I call your fireproof cushion. This is somewhere between $500 and $1,000 sitting in a separate savings account, untouched, existing for one purpose only, to catch you when life throws something at you. And life will throw something at you, I promise. Your car will need a repair. Your dog will get sick. Your hours will get cut at work for a month. If you don't have that cushion built first, here's exactly what happens. And I've watched this play out more times than I can count. You invest your money and the market dips, which it always does at some point. That's not a maybe. And then an emergency hits at the same time, and you're forced to sell your investments at the worst possible moment just to cover a $200 bill. That's not investing anymore. That's gambling with extra steps. And it's how good people lose faith in the entire process and walk away angry. So step one, non-negotiable, build that small cushion first before anything else. It doesn't need to be huge. It just needs to exist so you're never forced to sell at the wrong time. While you're building it, I also want you to do something most people find genuinely uncomfortable. And that's actually looking at where your money goes every single month. Not to shame yourself. I'm not interested in that. Just to see it clearly with your own eyes. Pull up your bank statement from the last 30 days and go line by line, every single charge. You're going to find money quietly leaking out in places you completely forgot about. Subscriptions you signed up for once and never canceled. Delivery fees and tips that add up to way more than you'd guess. This isn't about depriving yourself of everything you enjoy. It's about finding your first investing dollars hiding in plain sight. Because 9 times out of 10, they're already there in your life. You just haven't gone looking for them yet. There's one more thing that has to happen before we talk about the account itself. And people hate hearing this part, so I'll keep it short, but I'm not going to skip it. If you're carrying high interest debt, and I'm talking about credit cards charging you 20% or more, that debt is the enemy you need to deal with before you get aggressive with investing. Here's the math. Nobody explains clearly enough. If you're paying 25% interest on a credit card balance, and you're hoping the stock market is going to average somewhere around 8 to 10% a year over time, you are losing that craze before it even starts. Guaranteed, paying off that card is a guaranteed return of 25%. There is no investment on earth that guarantees you that kind of return. None, not even close. So yes, build your small cushion first. Then attack any high interest debt hard and fast. And once that's cleared, now you're truly ready to invest with real momentum instead of running in place while debt quietly eats you alive in the background every single month. I'm not talking about a mortgage here or a reasonable car payment. Those are a completely different conversation. I'm talking specifically about high interest consumer debt, the kind that compounds against you instead of for you, working against everything else you're trying to build. Now here's where it starts getting interesting, because once you've got that small cushion built, your high interest debt handled, and you actually know where your money is going, it's time to open the account that's going to hold your investments. This is where a lot of people freeze up completely because there are 100 different apps, 100 different platforms, and everybody online has a strong opinion about which one is the best. I'm going to simplify this for you right now so you don't fall into analysis paralysis. You want a brokerage account with no account minimums, no trading fees, and the ability to buy fractional shares, meaning you can buy a slice of a stock even if you can't afford one full share of it. Almost every major platform offers this now. So honestly, don't overthink the choice. It's not the decision that matters most here. The account itself matters far less than what you actually do with it once it's open. Once that account is set up, here's exactly where your first dollar should go. And I want you to really hear this part, because it's the part that separates the people who build real wealth from the people who gamble for a while and eventually quit and tell everyone investing doesn't work. Your first dollar should go into a broad market index fund, not a hot stock your cousin texted you about, not whatever's trending on social media this week. A broad market index fund, which is essentially a basket that owns a small piece of hundreds of the biggest companies in the country all at once, spread out. When you buy this, you're not betting your future on one company surviving and thriving. You're betting on the entire economy continuing to grow over time, which historically it has done decade after decade, through wars, through recessions, through crashes that felt like the end of the world while they were happening. This is boring. I know it's boring. Nobody makes a viral video about index funds because there's no excitement in it, no big reveal, no dramatic chart. But boring is exactly what builds real, lasting wealth. Because boring means you can hold on through the scary parts without panicking and selling everything at the bottom, which is the single most common and most expensive mistake I've watched people make over and over again throughout my life. Let's talk about the mistake that costs beginners the most money, because I need you to hear this clearly before you go one step further with any of this. The mistake is trying to get rich fast. Let me tell you a quick story, because I think it'll land better than me just lecturing you. Years ago, I watched someone close to me put almost all of their savings into a single stock because a friend swore it was about to explode. It did move for about 3 weeks, and they felt like a genius. They started telling everyone at family dinners how smart they were, and then it gave back everything it gained and kept falling. And within 2 months, almost that entire savings account was gone. That's not an unusual story. That's the normal outcome of chasing hot tips. It's just that the winners are the only ones you ever hear about, because losing money quietly isn't something people post online. I understand the temptation completely. I'm not judging you for feeling it. You see stories online about someone who put a few $100s into some coin or some stock and turned it into a fortune in a matter of weeks. And it lights up something primal in your brain that says, that could be me, that should be me. Here's what those stories never show you. And this matters. For every person who got lucky on a wild bet and posted about it, there are hundreds who lost it all and never talk about it publicly because nobody makes a video bragging about the money they lost. I've sat across the table from smart, hardworking people who blew through their entire savings chasing the next big thing, and I've done versions of this myself earlier in my life too, so I'm not judging from some high horse here. I'm telling you because I paid tuition for this exact lesson the hard way, and I would genuinely rather you skip that class entirely and learn it from me instead of from your own bank account. Real wealth is built slowly, consistently, and boringly through something called compounding, which is simply your money earning money, and then that new money earning even more money on top of itself year after year. A small amount invested consistently, left alone for years without being touched, will be a big lump sum thrown at some hot tip almost every single time, because time in the market beats timing. Market. That phrase gets repeated so often, it's become a cliche, but cliches become cliches because they're actually true. The market will go down at some point. It will happen next month or next year or the year after. At some point, it always happens, guaranteed. When it does, I need you to not panic and I need you to not sell. That dip is not a signal to run for the exits. Historically, it's been one of the best times to keep buying because you're getting more shares for the exact same amount of money you're putting in. The investors who build real wealth over decades are almost never the ones who time the market perfectly. They're the ones who kept showing up month after month, contribution after contribution in bull markets and in bear markets, and simply let time do the heavy lifting for them while they went and lived their libs. Now let's talk about how this actually scales as your income grows over the years, because starting with $50 or $100 a month is great, and it's exactly where you should begin. But I want you to think bigger than that too, further down the road. As your income increases, whether that's from a raise, a promotion, a side hustle, or a total career change, the goal is to increase the percentage you're investing, not just a flat dollar amount. Most people fall into a trap called lifestyle creep, where every single time they make more money, their spending quietly rises right along with it. So they never actually get ahead. They just end up with a nicer looking version of broke, with a nicer car and a nicer apartment and the exact same $0 in investments. Instead, I want you to commit to something simple right now. Every time your income goes up, at least half of that increase goes straight into investing before you even get a chance to feel it in your checking account or get used to spending it. If you get a raise of $200 a month, 100 of that goes straight into your brokerage account automatically on autopilot. You never see it, you never really miss it, and over years, this one single habit will separate you from almost everyone around you who's earning the exact same income but spending every dollar of it as it comes in. I also want to mention employer retirement accounts here, because if your job offers any kind of matching contribution on a retirement account, that is free money sitting on the table with your name on it. And I don't care how tight things feel right now. You find a way to at least capture that full match before you do anything else with extra money. Because turning down free money is one of the few genuinely irrational things you can do with your finances, full stop. Let me put a real number on all of this so it doesn't just sound like a nice idea. Say you're 25 years old and you start investing $200 a month into a broad index fund, and you never increase it, not once, for the next 40 years. Historically, the market has averaged somewhere in the range of 8 to 10% a year, though of course nobody can guarantee the future looks exactly like the past. At even a conservative average, that $200 a month can realistically grow into somewhere close to $500,000 or more by the time you're 65, and most of that growth doesn't come from the money you put in. It comes from decades of compounding, quietly working in the background while you were living your life, raising a family, changing jobs, taking vacations. Now imagine you actually did increase that contribution over time as your income grew the way I just described. That number gets dramatically bigger. And this is with no lottery ticket stock pick, no crypto gamble, none of it, just consistency and time. Beyond the index fund and any employer match, as you get more comfortable and your knowledge naturally grows over time, you can start learning about individual companies, real estate, or other assets if that interests you. But I want to be completely honest with you here. Most people never actually need to go beyond consistently investing in a broad index fund and simply letting time work in their favor. It's not sexy. It won't make for an exciting story at a dinner party, but it works. And it has worked for longer than any of us have been alive to watch it happen. One more thing I want to leave you with, because it matters more than any stock pick or clever strategy I could ever hand you. Your biggest asset right now, today, is not your money, it's your time. Whatever amount you start with, whether it's $20 or $200, the person who starts today with a small amount and stays consistent for 20 straight years will almost always end up ahead of the person who waits 5 years to start with a bigger amount, because those early years of compounding are doing work that later money simply cannot go back and replicate, no matter how much you throw at it afterward. So stop waiting for the perfect moment, the extra bit of savings, the market to look safer than it does right now, because that moment doesn't come. I've been doing this long enough to tell you that people who wait around for certainty are usually still waiting a decade later, having lost 10 years they can never get back. Open the account this week, not someday, not when things calm down, not when you get that next raise. This week, set up an automatic transfer, even if it's small. Even if it's an amount that feels almost embarrassing to say out loud right now, let it run quietly in the background of your life while you go out and actually live it. Check back in on it in a year. And I promise you, you will be genuinely shocked at how far a small, consistent habit takes you once you finally stop overthinking every little detail and just start. So here's your challenge, and I mean this literally. Not as some throwaway line just to close out a video. Before you close this out, open your banking app right now and move $50 or whatever amount feels real and honest for you into a savings account you're going to label your investing fund. Do it right now while it's fresh in your mind, because motivation fades fast. And I don't want this to be just another video you watched and forgot about by tomorrow morning. Then this week, open that brokerage account and set up your first automatic contribution. Even if it's a small one, I genuinely don't care about the amount you start with. I care about the habit you're building, because the habit is the whole game. Come back to this exact video in 1 year and watch it again. I promise you, if you actually did what I just laid out, the person watching it a year from now is going to feel completely different about their money than the person watching it right now. And that gap only grows the longer you stay consistent. The people who end up wealthy 20 years from now are almost never the ones who made one single perfect decision at the perfect time. They're the ones who made a boring, consistent decision over and over and over again, month after month, year after year, until one day it quietly added up to something extraordinary that looked from the outside like it happened overnight. It didn't happen overnight. It happened in the boring middle, the part nobody films. the part nobody talks about. If this helped you see investing a little differently today, subscribe because I've got a lot more of this coming. And honestly, I'd rather you hear it from someone that's actually lived through the wins and the losses firsthand than from someone selling you an overpriced course. I'll see you in the next one.